Right, good morning, everybody. 11 o'clock. We'll get going. So this week's guest is Ian Nance of Temple Bar. But first, as usual, I've got a couple of bits of news to have a look at. So the announcement this morning was quite a big one. So Aberdeen, New Dawn and Asia Dragon are going to merge. So we'll talk about that. And then Digital9 Infrastructure has been busily updating people over the last couple of weeks. And sort of cumulatively, it seems to be having a positive effect on the share price, but we'll see where we go. Let's talk about the two Asia funds first. I'll put the charts up here side by side, and you can see, firstly, they're both on big discounts. Secondly, as you can see there, Asia Dragon's not really been doing as well as Aberdeen New Dawn, and that'll show up later on in the numbers. And also, Aberdeen New Dawn's been much better at controlling its discount than Asia Dragon. But nevertheless, both of them are on big discounts. What they've said this morning is that they're going to combine forces, but the way that's going to happen is that Asia Dragon is effectively going to take over Aberdeen New Dawn. We've discussed this before. It's a Section 110 under the Companies Act reconstruction, so that the Aberdeen New Dawn fund gets wound up and then folded into Dragon, and it's all being done on a formula asset value to formula asset value basis. So it doesn't matter that they're both trading at discounts. It's still fair to both sides of the shareholders. Because you just merge at NAV. So for the Aberdeen New Dawn shareholders only, there's an opportunity to cash up at this point. And that's limited to 25% of the fund, and that's being done at a 2% discount to a formula asset value, which also includes the costs of liquidating the portfolio to provide that cash. So basically, it is a 2% real discount. The benefits of that 2% discount flow through to the ongoing shareholders. So basically, they're saying if you want cash, you've got to pay for it. The default option is to roll into Asia Dragon. Everybody gets a vote on this, whether you're an Asia Dragon shareholder or whether you're an Aberdeen New Dawn shareholder. But they have already got quite a lot of support because there's some fairly big shareholders that being anxious for something to happen. And so they've got more than 25% of shareholders on both sides have already said, yes, we're going to vote for this. The timetable, we should see a circular and then a vote, I think, both in September and then effective, they say, in October this year. The managers will be Prutzka, who we talked to here before, and James Tom, who we also talked to, and not that long ago, actually. The only sort of real substantive difference between the two funds was that the Aberdeen New Dawn fund could invest in Australasia and the Asia Dragon fund couldn't. So they're going to tweak the remit of Asia Dragon so that it will include Australasia. The weird thing there is they're not going to tweak the benchmark too. So the Asia Dragon benchmark is Asia Pacific ex-Japan, whereas So Aberdeen New Dawn is Asia Pacific ex-Japan, where Asia Dragon is Asia ex-Japan. And you would have thought, if you're going to put Australia into the remit, that you would also change the benchmark at the same time. I don't know whether or not doing that, but there may down the line be a question mark about that, especially if Australia massively underperforms or outperforms, and they benefit from that. Now, one of the sort of lame things, I think, and I'm trying not to be too critical about all this, but they are not going to rationalise the board straight away. So everybody gets to be on the new board, more or less. So it goes up to 8, apart from, I think, Hugh Young. They don't actually specifically say that, but I think that's the implication. He's been on the Aberdeen New Dawn board for over 34 years. But they will eventually, after 6 months, shrink back down to 5 again. Which is a more sensible number, and it's quite sort of formulaic, 3 from Dragon and 2 from New Dawn. So there we go. I mean, it's always been said that one of the resistance to funds merging is that the fact that directors lose their jobs. It's sort of reinforcing that argument here with what's going on. But there we go. In terms of size, I say Dragon's a bit bigger, but it also trades at a wider discount. So what they're saying is, you knock the two together, you get more liquidity, you get some economies of scale, and they are even better than it looks because they're lowering the fee. So the upfront fee on the first 350 million of assets is dropping to 0.75 from 0.85. And also Aberdeen, as part of this to sort of sweeten the pot, is going to waive its fee on the New Dawn assets that transfer for the first 6 months. So that helps sweeten the pot for the Edge Dragon shareholders and makes it more likely that they will vote in favour, I think. As I say, this just looking at the things in the sector, these are the two funds on the widest discounts already. And Dragon is on a bigger discount than New Dawn, which is not potentially, I suppose, helpful. So that does need to be tackled. And here are the returns, and they are also the two worst performing funds in the sector by quite a long distance. And Dragon has underperformed New Dawn, and again, that really isn't helpful. But I suppose that, you know, I don't know why it's not New Dawn taking over Dragon. To be honest, it doesn't make more sense to sort of make it that way. But maybe this is the whole argument for including Australasia in there. Maybe they're going to make Dragon a lot more like New Dawn. And this is just from Age of Dragons fact sheet, so you can just see here how it's been doing over the past 5 years against this benchmark. And it more or less matches it over 5 years, but since then it's been underperforming. Not great, really. The Dragon shareholders have a 5-yearly conditional tender offer, which is triggered if it underperforms the benchmark over a 5-year period. The first of these periods ends on 31st August 2026. And I think when they introduced that, I said that's quite a long period, and maybe too long, for up to 25% of the shares. One of the things that they're doing is saying we're going to shrink that down to 15%. On the grounds that it's a combined fund and they don't want you to shrink too much. I honestly, if I was a Dragon shareholder, I'd be slightly upset about that. I'm not sure that the logic entirely stands up for me. But there we go. There is a continuation vote in 2026 as well, but I don't think we're likely to lose that at this stage. But having said that, if that underperformance persists to that degree, then there might be question marks about it. So as we get closer and closer to that August 26th date, if it seriously underperforms up to that point, I think people will be going, we want something to happen before then. But as we get there towards that date as well, people might be saying that's not enough, but anyway, we'll have to wait and see. Digital9 has been fairly dreadful, as we know. The main trigger for everything going wrong, if you remember, was that the fund manager walked out. This has been sort of a common thing across a number of funds now. It sort of happened on the quiet with VH Global Sustainable Opportunities, Energy Opportunities the other day. And that sort of led to a sort of steady deterioration in the share rating. Obviously, the other problem it had was it couldn't raise more money to do all the things it wanted to do. So it bought a bunch of great businesses and it needed to put capital behind them, and then didn't have the capital to do that. So they just assumed that they could carry on expanding, and that obviously wasn't the case. And obviously that's left it on a massive, massive discount. But there has been a sort of little pickup, and it is very tentative here. And I wanted to talk to you about why that might be happening and why it might continue. So performance-wise, not too bad. But these are NAVs, and everybody's not quite sure whether the NAVs are right or not. It's one of these question marks that has to be resolved. So one of the things it's going to do that will help that, I think, is to sell a slice of its investment in a data center business in Ireland called Iceland, called Verne Global. So on the 5th of June, it said it was going to do this, and it also said it secured some finance for that company as well to allow it to sort of pursue its growth agenda. So that's a sort of tick in the box. Then it said on 13th of June, we've actually now got a new manager. So that's a big tick in the box. So that was the thing that obviously upset people originally, and hopefully that calms people down. It had inflation-linked debt on one of its investments, Arqiva, and they've managed to cap that inflation uplift on the debt at 6% on 21st of June. That's another positive. And then they refinanced that debt on the 5th of July to give it, again, a bit more wiggle room to borrow some more money. So it could borrow an extra £83 million after that. Then last week, the ex-managers said, we don't want to bid for the company. But the fact that they'd even had to comment on that, I think people thought, oh, you know, this is interesting. If I've been saying for ages that I think this is maybe vulnerable to a bid, but there we go. What they've said this week, firstly, is that there are a lot of people that want to get into this phone global syndication. So we're going to see an announcement on that in the third quarter, so from October onwards. That's good news because that proves the NAV. This is one of the things we've been saying on a whole bunch of these funds. If they can sell assets at the current NAV, then the doubts that people have got about whether these are right or not should ebb a bit. Now, obviously, raises cash to do other stuff. They're looking at other things that they can do to raise more money to grow the existing investments. We'll have to wait and see what that turns into. They would do share buybacks if they had the cash, but they don't have the cash at the moment. But the implication is when we do, we will buy back stock. They have bought shares themselves to kind of reinforce the message that they think it's cheap. And they've reaffirmed that they're going to pay the 6p dividend target that they've got for 2023. That even though that's not actually covered and probably won't be covered until the end of next year, their argument is actually that the degree of uncovered dividend cash-wise is not that big that it would make a huge difference to things whether they paid it or not. So having said they're going to pay it, they're going to commit to going to maintain their target. So there we go. They've got some cash with what they have done so far already to be able to pursue more investments. And the Verne Global thing might make a big difference to all of this. So basically what it says, it seems to have now set a floor under all the things that were really wrong with it. And hopefully, as long as the growth of the businesses still keeps coming through, it will turn around now and be a bit better, but we'll have to wait and see on that. So that's enough from me.